Good morning, it's Jeffrey Cohen, Investment Advisors Representative for U.S. Advanced Computing Infrastructures Incorporated. We operate under the name Chicago Quantum. Today I'm going to share with you a blog post that we posted last night, which effectively called the market. We had said that today the markets are starting in a risk-off perspective. So last week we kept a low profile. We did not make a single trade. Our hedged managed accounts right at the moment are 100% cash. Those are paper traded accounts, 100% cash. They generated good profits, but what's happened recently is the market has shifted. What we found when we posted this blog last night was that the expected return from the risk portion of the U.S. equity market, so benefit of risk is 4.8% over the next 12 months, and that's including dividends. And that compares or incorporates a risk-free rate of 4.2%. So that's not a very large return. So what does it mean? It means that these conditions require, just all else being equal, they require larger portfolios. At least 20 to 35 stocks held evenly. And it may not even be that significant of an advantage of a small, simple portfolio of maybe a couple of exchange-traded funds to get you your diversification, such as the Spider, Shy, and maybe 1, 2, 3 other stocks. So we're suggesting the market is risk-off this week. We did not know about the China thing. And honestly, the model will reflect that after the fact. Our down run. So we have 2 runs that we do that you can purchase. One of them picks the stocks that we would say avoid, run away from. They're terrible. Oh my God, you gotta go, right? Like don't buy them, maybe short them. Okay. There's 809 of them, and we just do a very simple screening to get those stocks, and then there's intensive data validation. Well, they have a stock variance of 8.0 times 10 to the negative 4. This compares very unfavorably to the variance of the S&P 500 ETF, which is 2.3 times 10 to the negative 4. That's 3.5 times the variance. So you can invest in money-losing company stocks, or you can buy the S&P 500 and get 3.5 times less the variance. By the way, the 2.3 compares favorably, evenly, to the variance of all the money-making stocks, which is a 2.6 times 10 to the negative 4 variance. So, money-making stocks in this economy actually aren't significantly higher risk than buying all the S&P 500. What else did we see? Many biotech firms at the top of our stock list. The number 1 stock to avoid is ALLK. You can buy a number of portfolios with ALLK and one other stock and get a really terrible risk-return trade-off. And there's a few non-biotech meme-like names that you can match up. If you bought a run, shoot us a note. We can get you that. You'd have all the data as well, right? And you can make your own decision. Which 2 stock short are you going to play? It's interesting because 30 stocks right now of money losing, down run stocks have a beta of 2.5 or higher. So these are stocks that are moving with the market. So interesting. So they're not necessarily going down dramatically yet. They're just super high risk and super high beta. So finally, I know a lot of you like negative beta stocks. It's like a thing, right? It's like finding a unicorn. A negative beta stock moves in the opposite direction of the S&P 500 or whatever index you might be using. Berkshire Hathaway, B shares, 12% negative beta. VERU, Veru Inc., negative 86% beta. SPRY, which is Aris Pharmaceutical, is roughly flat, so it's roughly independent, but it's 4/100ths or 4% negative beta. Now, what did we find? You know what? Yeah, let's do it. What did we find in our up run? Well, there's 1,710 profitable stocks that we found that passed data validation that are U.S. listed. And they have a variance of 2.6 times 10 to the negative 4 if held evenly. That's a very well diversified portfolio. And it's only 13% higher variance than the S&P 500, which in our mind isn't even that significant. So, what do we notice? Well, the most important thing is that you can have your cake and eat it too. You can just decide to invest in money-making companies during this tough economy, and you'll do okay from a risk-return trade-off. What else? 50 stocks. The 50 stocks with the smallest volume on Friday. Now, Friday was a short trading day. Right, those 50 have really small trading volumes. All 50 are at 14% or less of last year's volume. That's actually really low. Now, the 50 stocks with the largest volume were at 81.7% of last year's volume. So even the most traded stocks really didn't have that much volume. 205% of last year's average volume for the top 4 stocks. 205 or more. There are stocks that have gone up in price and stocks that have gone down, right? So they've gone down 3/4, 75%, or they've gone up twice, 100%, a one bagger. So there's movement in prices over the past year now, given where we are now. There are high and low beta stocks at the extreme ends of the spectrum. So if you like money-making stocks that have almost no beta, and if you like money-making companies that have exceptionally high beta, 2.5 or above. So if the stock market goes up 1%, they go up 2.5%, you got it. Okay? So you can buy both. You can buy either one. Our model normally picks high beta, low variance stocks. We pulled out. We had to pull out because the model was suggesting that that is not where you want to be right now. Get out, and don't be in the high beta, high risk stocks. Now, why is that? It's because on a day-to-day basis, there's a lot of really bad movement out there. If you were to look, let me see if I have something that would help us. Yeah, this is good. This was the November 15 up run. So these are the stocks that on November 15, which is 13 calendar days ago, figured 2 weeks ago. You get stocks like UEC, which is a uranium company. Synaptics, you have a semiconductor company. You have a surgical support services, support products, even NVIDIA. Coinbase, Melly, AppDynamics, AMD, right? Blackstone. And what you look here and you see is, first off, the entire uprun is down, and the downs are pretty large. Low volume, though. Exceptionally low volume. Exceptionally low volume. So, market is kind of collapsing under its own weight, I guess you would say. Low volume, low liquidity. Things aren't doing so well. So this is not a risk up. This is a risk on. This is a risk off day. And it's okay. It's okay to be risk off. It's okay to just take a break, move to cash, if you can, right? So is there anything doing well? Probably. My guess is retail's doing okay. But the high beta stuff is rough. So if we look at just semiconductors, chips and semis, normally these are high beta just as an industry sector. One green, all red. Okay, what else? Cannabis and tobacco. That's always good for nothing. A lot of red. How about retail? Let's go look at our retail. Now, this is large cap to small cap. So large cap, with the exception of the specialty, like discount retailers at the very bottom. You know what? I'll stick them on top. Here we go. Boom. The largest caps, Amazon and Walmart, doing well. Home Depot, Costco, Interesting, Alibaba's up with all the protests. Target. It's mixed. The retail picture is mixed. Okay, that's fair. How about banks, regional banks? This is just a full set of regional banks. This is not, we'll do by market cap. That's not a correct market cap. There we go. So you can see the largest regional banks, actually U.S. national banks, are down. Regional banks are down. A lot of down. A lot of down. There's not a. You have to get to a $400 million market cap bank, EBTC, Enterprise Bancorp, to have a positive day. These volumes are atrocious. These volumes are atrocious. These volumes are atrocious. They're tiny volumes. And so today's a risk-off day. I think I just proved it to you. I'm happy to maybe we look at FinViz futures, right? The U.S. dollar. By the way, I've been looking at this. I'm not sure I understand why the dollar is this down. Why did it fall? I don't know. Maybe somehow people think that I don't know. Every little thing's going to be all right, but look at that oil breaking through 75. We haven't seen that price since January. It's risk off. It's risk off. I don't know what to tell you, people. This is a tough market. Now, what's interesting here is you see how the market, like, it broke the mold there. And now it's down. And I get it, it's down in October. But it's been climbing pretty nicely from 3,600 to 4,000. There's no reason to think it won't keep going up. There's also no reason to think it won't be coming down. But this is the index. And so it's very, and by the way, look at that volume fall off right there. Volume falling off. Do you guys see that? I'm going to zoom in for you. I'm not a technical analyst. I'm really not. It's not my thing. But look at the volume fall off, right? Up days, great volume, right? But the market's falling. I don't know. In low volume days, it's mixed. It could be up or down in low volume days, but wouldn't surprise me if Santa Claus decided not to come this year. Kids, if you're listening, there is a Santa Claus. And whether you believe there's a male or female Santa Claus, so personally we believe that the next Santa Claus should be female. There's no reason why the chairman of the board of Santa Claus Enterprises can't be a woman. She's got to be a little large. She's got to wear a fake beard or whatever. Maybe she doesn't wear a beard. Maybe she just has long hair. But I do believe in Santa. I just don't believe that Santa comes to the stock market. I don't know. So let's take a look. We look at the euro at almost 104 or 104. We look at Japanese yen at 138. We're nervous, right? Great British pound, Canadian dollar. But when I look at this, I think immediately, what happened to the dollar? Why did it collapse? Why did the dollar collapse? Why is the euro at $1.04? I honestly don't know. I have no clue. Nothing. I guess we could take a quick look at the S&P 500. I mean, it's a great looking chart. It is a very bullish chart. I like the S&P 500. I think it is working so hard. It came up. Look at that. Look at that gap up. What happened on November 9th? There was an election on November 8th. I got it. It fell after the election and then boom. It must be because the Democrats won the Senate. That's fine. Maybe, status quo. But I'm not really sure why that happened. But that set off a major buying frenzy. Got us to 4,000. It dropped. It came up. It's just hard to know where we're at. But this is a very solid healthy looking chart. I got no issues. I have no issues with this. So the question is, what else did we see? So now that I've shown you it's a tough market, so how would you beat the market, right? The best 15 up portfolios, meaning the 15 portfolios with the best score, where you hold the stocks evenly, are all within one tick of each other, which I believe is 10 to the 6th, which is nothing, right? It's like a tiny, tiny, tiny tick. So there's 15 portfolios all within a tick, which basically all the same score. And they vary from 18 to 23 stocks. Now, we've had this model run and pick 2 stocks. 18 to 23 stocks is a lot of stocks. It means you really have to diversify out. This thing's crazy. Now, if you want to retain 37% of the edge, you can hold a 7-stock portfolio. I just want you to think about that, right? So normally there's some, heuristic. Buy low, sell high, right? 60-40, stock to bonds. But in this case, you'd be holding QQQ, SPY, those are ETFs that trade stocks, that track stock indexes. SHY is an ETF that tracks 1 to 3 year debt securities, and 4 individual common stocks. And those individual common stocks vary. So the good news is you can kind of pick from those different portfolios. That's nice. You don't have to take our word for it. You got a couple different options there. This is all based on trading, not on fundamentals. And there are some negative stocks, negative beta stocks. So one is Chesapeake Energy, and that one, by the way, it's just a weird bird, so don't know. And then you've, of course, got your short QQQ, you got your VIX, and you got your bear funds. And then you got a dollar index. Of course, dollar goes up, stocks go down, vice versa. So with the dollar falling, you would expect stocks to be going up. What's interesting is dollars falling aggressively, stocks aren't really going up. I mean, they're up to 4,000. It's great. So how does this 18 to 23 stocks compare to what we did just 2 weeks ago? Well, our previous managed accounts had 12 stocks, roughly. Sometimes 10, sometimes as much as 15. But in general, it was a smaller portfolio. And every once in a while, we had to keep an extra stock or two in there because the model would kind of kick out a stock, and then it would bring it back. So we like to give the model a chance. And so it reduced trading costs. It was nice. It worked. But so 12 versus 18 to 24, call it, you're talking 50 to 100% more stocks. There's one more thing. We do not offer this run to the public, but we do run a QQQ run. Now, if you really like this, it's kind of cool and it gives a different answer. It's subtle, okay? So instead of using the S&P 500 as a base, you could use the QQQ or the NASDAQ 100 as a base to the whole analysis. Boom. We get a second look. It's great. We learn a lot about this. So, but it costs money. It would cost you money. I don't know that you want to buy both. I mean, it's fine if you do. We'd probably give you a discount if you bought all 3, right? Love that. By the way, I'd give you a discount anyway. Just call me up. Be like, Jeff, I want to buy some runs. I want to run every week. Done. So what we learned is you can hold 3 stocks and hold 82% of the benefit of a fully sized 34 stock portfolio if you assume that the QQQ is the basis for comparison. It was not available for the S&P 500. So if you live in a world of S&P 500, you got to buy 7 stocks and you get 37% of the edge. Here, if you think the QQQ is God's gift to stocks, there's a 3-stock portfolio that gets you 82% of the benefit. By the way, there's also a number of 4-stock portfolios that get you about 80% of the alpha. And in order to get that same 80% of the alpha, you'd have to hold portfolios of about 100 stocks. So you're in this weird scenario where if you believe in tech and you want to diversify, you want to hold on to some benefit from the market, risk versus return, you have to hold 100 stocks. roughly. Now, the best portfolio is 34 stocks. My guess is that 34 stock portfolio would have some ins and outs, puts and takes. And so what would happen is you'd have trading costs. My guess is if you're holding portfolios of 100 stocks or more, you could actually almost zero out your trading. Because my guess is those 100 stocks, roughly speaking, would be the same. But the fact that you could buy a 4-stock portfolio and just run, wow, that's great. So, this is interesting, but this doesn't give us that kind of like warm, fuzzy feeling that this is a risk-on market. What we see is that at least the data tells us maybe the market peaked. Maybe it's time to take a break. Maybe it's time to buy 18 to 24 stocks and hunker down. So I look at the hedges that we've used in the past. I didn't even realize this was up on the screen, but let's show you. Let's share some data. You know what? I think it's important that you, the listeners, get the benefit. Now, if you would have bought the run, you would have had this over the weekend. So you would have known all this. So you look at BORR, Snap, Grab, Everbridge. Now, by the way, these are not the current hedges today. These are not the best hedges today. They're the best hedges from like 3 weeks ago. But take a look. They're all down. S&P 500 is down. We look at an old long run against the spider. Apple. This is an older run, so it's not where we are today. Broadcom, BX, right? Earwax, Intuit, Microsoft. Earwax is European Wax Center. One or two up, but for the most part, this is a down portfolio, right? I could show you our holdings. Our holdings, Qubits, which is D-Wave. We're a quantum company. Why wouldn't we hold some D-Wave, right? You have to. Corbis, our perennial worst stock holding in the history of stock holdings. We are tragically bullish on Corbis. CFR, Cullen Frost Bank Shares, and Verizon. And Verizon, we actually hold the calls. And so another tragic decision of our investing. So that's why the fund works great on emotional. You're not picking stocks. You're picking math, basically, risk return. And that's what I tell you. This is the time when you want to be picking math, not making bets on individual stocks. That just seems crazy to me. How do you know which stock's going to go up and which stock's going to go down? Look at this. You have whole industry sectors that just moved. Communications, it's pretty much all red. Tech, almost all red. Financial, healthcare, industrials, real estate, utilities, basic material, energy. But consumer cyclicals and consumer defensive, they're okay. Healthcare, drug companies, okay. It's not a stock picker's market right now. This is a bloodbath, and it's a risk-off market. So it doesn't mean the market's going to go down. It just means that the model tells us you have to diversify out all this stuff. And so we share this. You could just come to our website. So the way you get to it, come to chicagoquantum.com. By the way, we simplified our webpage. My son told me I should, so I did. I don't know. I'm no website guy. But if you want, by the way, if you want to occasionally get a newsletter or an update, I don't think we've sent one out for 3 months, so it's not like you're going to get a lot of mail. Go ahead, type in your email, say you agree to receiving materials, and I promise you won't be over spammed, but you might find some good stuff. We have our quant analysis. This is where you can buy stuff. We have an alternative investment opportunity which you cannot buy unless you prove that you have the wherewithal and capability to afford the risk of investing in managed accounts. We also have a minimum investment, but you can actually get to that over 6 months or so as long as you let us know. It's risky, so you might want to work your way up. But it does well because it picks the least amount of risk with the most amount of expected return together, and then we hedge it. So, project services, you can buy a project. We have lots of projects. We can do general IT management stuff. We could do portfolio optimization work. We could actually help you with quantum computing strategy and development. It's a lot of good stuff there. I think you should take a look. And then we have a ton of market information that we provide for free. I don't know why I do that, by the way. I think I do it because I want to get clients, so I share all this information from the runs. But if you like it, you would have all this information every single day if you want. Quantum computing, we got some older information. We haven't updated that in a while. And then the blog is today's insights, and that's where we posted the November 27 insight. So I want to thank you for watching. I think it's great if you're into the stock market and you're into some math. You can see that it is a risk-off market this week, even with interest rates going down. So maybe there's one more point to bring up. Let's go to the videotape. Where are we here? All right. So 13-week Treasury bills are at 4.18. 2-year Treasuries, so it's risk-free, is at 4.46. But the 5-year, 3.88. The 10-year, 3.69%, which is low. And the 30-year, 3.74%. So the question is, why? Why, Jeffrey? Why are they priced this way? And I'll give you the answer, and I'm not sure you're going to like it, but it's everyone is confident that the Federal Reserve is going to beat inflation in the next 2 years or so, that they're going to pound inflation into the ground. Now, there's a picture in the background, which you should be able to see, and I'm going to see if I could zoom in. By the way, I don't know if I can, but let's see if I can. Video capture. Scale. Oh, come on, please, please, please give me the ability to zoom. No, I can't. I'm so sorry. I can't. But this picture right here is a picture from the 70s. And it shows inflation, the great race between wages and prices. And this was at the time when the U.S. Congress voted to raise the pay of the congresswomen, and congressmen. I love it. I've had that picture for 20 years, and I always think about inflation. I've thought about inflation when it was zero. I didn't care. I always think about inflation. Inflation is the number one destroyer of wealth in our economy. And so people are just feeling good. They're like, yeah, the Fed has got this handled. But I'll tell you what, I'm not sure the Fed has this handled. And that's why I'm not sure I believe. The 13-week Treasury at 4.17, 4.18, I'll buy that. I think that's going to be 5% before long. The 2-year at 4.5, that's also going to be 5%, maybe 6%, right? Because we got to beat inflation, and we want real interest rates to do so. Now, the 5-year and the 10-year at 3.88 and 3.70 seems light. But, again, people believe. People believe that the Fed is going to dominate and destroy inflation by crushing the money supply. And maybe they will, but here's the part I don't buy. If they're going to crush inflation by reducing the amount of money growth, so reducing money growth, and by doing it in lots of ways, then the dollar should be stronger. And we're going to take a look. Where's the dollar, Jeffrey? Show me the dollar. Do it. Foreign exchange. Give me a dollar index. Come on. Where is it? Here it is. So we look at the dollar. How it's grown, right? Since 2022, January. It was at 94. Hit 114, went up 20, went up almost 20, 25%. It's down to 106. So why did the dollar crash? And if the dollar's crashing, what does that say? So interest rates have dropped, and so the dollar has dropped because the dollar is pricing in interest rates. I need to make that smaller for you. Hang on one second. So dollar falls because the interest rate on the US dollar is falling. And so it's a demand for dollars. There also could be something in there about imports, exports, and a slowing economy. So that's real. Because if you export to the US, you're paid in dollars, you ultimately have to sell those dollars, which drives it down. So it could be that they're not finding a way to sell their dollars, right? They're not buying U.S. goods. So there's a global recession that's driving down demand for U.S. goods. It's also possible that foreign money is not pouring into the U.S. making investments. It's possible. It's possible that, that storage center that should have been sold 55 times already isn't being bought. Land in the U.S., business in the U.S., stocks, bonds. People are holding their money closer. As money tightens up, foreigners are holding their dollars. So there's less demand for dollars. It could be that as well. So you have interest rates, long interest rates falling. You have the dollar falling. People believe that inflation will be crushed. I think it's great, but what I'm seeing is very low liquidity in the markets and higher risk in the markets. Low liquidity, high risk means risk off. Because you might make 1% or 2%, but you might lose it all. I don't think you want that risk. I think you want to sleep at night. So now I'm going to say goodbye again. This is Jeffrey Cohen with Chicago Quantum, U.S. Advanced Computing Infrastructures, Inc. You can buy our quant runs. We'd love to sell them to you. This is what we do. This is how we make a living. We also have an alternative investment opportunity. We are currently proofreading our brochure to give you all the information that you might want. Both on our regular quant services, project services, hourly services, and our alternative investment opportunity, which is effectively using the Chicago Quantum Net Score for smart volatility, hedged, managed account. Thank you again. By the way, if you like the video, we're not paid to make the videos. Hit subscribe, hit like, drop a comment. We'd be glad to talk to you. Thanks.